hit the record button.
that we definitely should do.
So, all right, we got 2 minutes till we'll go, and then I'll just get busy and we'll go into it.
Awesome.
So what's you got? I've been texting with Seidman too. So I said we got to get this dinner on the books at least get it, scheduled so we get to it.
Awesome. Yeah, I actually I grabbed coffee with him this morning. So
that's what he said that. He mentioned that. So how was that? Everything good?
It was good. Yeah, no, just caught up, talked about weird shit that's going on in crypto, weird group one people we know together. We talked about wine, the usual.
Weird group one people like Ben Londergan.
Ben did not come up,
okay.
But
there
are plenty of others in that bucket.
That's funny.
Well, we're talking about like the vaccine mandate, like they're struggling with whether, people come back to the office, do they mandate the vaccine?
That's crazy.
And it's a tough question because I think a lot of the employees are actually asking them to.
Really?
Hey, I'll come back, but you got to mandate it.
Right.
So, glad I am not in that camp. I don't have to worry about making that decision.
No, that would suck, man.
It's just a hard management question, right?
I know. I'm not, I don't know. I don't know where I fall. I got the vaccine. I don't care. But at the same time, I don't really want to mandate it for people. I don't think. Maybe I do. I don't know.
No, I feel like a mandate just feels strong, right?
Yeah, it feels a little government invasion, and where does it stop then? Like, oh, guess what? I'm going to a restaurant. I want to know if everyone has their HIV test, so I'm not getting my food or something like that. I mean, where does that all end up? Show me your medical records.
Exactly. Like, are we going to mandate the flu vaccine then?
Right.
Like, we mandate the polio vaccine in schools, and that seems okay. Maybe we're just used to that, but yeah. Anyway, it's 11 o'clock.
Okay, you ready? I'm gonna start it. Bingo. It is. Let's get started. Okay. Hello, Mark. Welcome. Options Brew TV Market Shot, our Thursday edition. Today, we are going to talk about covered calls, a strategy I think that is simple enough to understand, especially if you're new to options, right? And effective enough to really, if you're consistent, you can really do this well. Is that safe to say, Mark?
I think that's exactly right. And I think that's really the beauty of this strategy is that it's often the first option strategy that people learn. It's the 101. It's the most basic you can do. It's the first option strategy that you're allowed to do in most brokerage accounts, but it can also be incredibly powerful. And I think there's a real beauty in this simplicity, and it can be great in portfolio management. It can be great for single stocks. It's a really interesting strategy to dig into, and I'm really looking forward to going over it.
All right, great. Well, let's get right into it. What do you say?
Yeah, let's do it.
All right.
So I want to start out before we totally get into it. I want to talk about I came up with 3 rules for covered calls.
Okay. I love rules, by the way. I love rules.
Sorry?
I said I love rules.
Rules.
Right? For me, rules are like instructions. I love opening a package and you have instructions and you follow the rules and you end up with this beautiful thing that you built. This is going to be the same thing, I think. I love rules.
Exactly. So these are the things that you want to keep in mind when you're going to engage in a covered call strategy. And we'll get into the mechanics after that, but Start out keeping these in mind. So rule number 1, they're not free money. So let's just get that on the table right now. Selling calls against your stock holdings does not generate money out of nowhere. It'd be lovely if it did. It'd be lovely if we had a strategy that had free money, but this is a strategy that does inherently take some risk, and you are trading off one thing for another. So it's really important to keep that in mind when you're planning on a covered call strategy.
Okay, well, this is important, and we should know this in general, right? That trading, period, there's no such thing as a free lunch, right? Just anything you do.
Nope. If there was, then there wouldn't be enough room on the beach for all of us.
That's right. All right. Rule number 1, we understand, we like it, we get it. Very good. What's rule number 2?
Rule number 2, consistency is king here. Oh. So another important thing to remember about this is that it's a strategy. It's not just about one trade. It's about repeating this over time. That any single trade can go one way or the other. You expect the market to zig, sometimes it zags, sometimes we go up instead of down. One single trade isn't necessarily what we think about with a covered call strategy. You want to be repeating this over time, that it's about, getting a lot of singles, and sometimes you strike out, but consistently trying to put people on base, consistently incorporating this into your strategy.
Right. So this is I think people refer to this covered call strategy. It's an income producing strategy that has risk, but that's the goal here. And income isn't going to be generated in that one shot. It's just going to be, each and every expiration cycle, or if you're doing weeklies, just got to keep sticking to your rules and consistently doing it.
Sometimes you're going to win, sometimes you're going to lose, but doing this over time should put your portfolio in the risk adjusted position that you're looking for.
Okay, perfect. Rule number 3.
Rule number 3 is no FOMO.
No FOMO. FOMO, fear of missing out, right?
Exactly. So when you sell a covered call against your stock holdings, if that stock goes up, you would have been better off if you had just sold that, or if you had just held that stock and not sold that call.
Okay.
That's going to happen. You're going to be short a call, stock is going to run through that, and you're going to say, I wish I hadn't sold that call.
Right.
But if you're performing a covered call strategy, that's not the right mentality to have here. You have to think about it again with that consistency element, and again as a trade-off of collecting that certainty now in the form of income in exchange for giving up the uncertainty of the potential price. Sometimes that uncertainty goes up, but when you're executing covered calls, rule number 3 is no FOMO.
Got it. Okay. Understood. I always fear I'm missing out on something no matter what. My whole trading life, I was like, oh, I wish I hadn't done that.
I wish I hadn't sold. I wish I hadn't bought. I wish I hadn't done either. Yep.
Yeah.
No.
That's okay.
But important to keep in mind here, stay consistent, no fear of missing out, and they're not free money.
Got it. Okay, good. Let's come back to us again. So those are great 3 rules, right? Now you're going to talk about the setup mechanics of this covered call strategy, right?
Exactly.
So how do we do this? Let's get right into it. I'm going to have some questions. I know that. Tell us what we do.
So at a very high level, sort of like I alluded to, a covered call strategy is about selling calls against your stock position or against a stock position.
Okay.
So if you are long the equity, you want to sell calls against that position, and you collect the premium from those calls. And if stock goes up, you will benefit from stock rising, potentially up to your call strike, but you'll also be exposed to the downside. So that is one of the risks in this position, is that you will still be holding the stock.
Right.
The income that you collect from selling that call will offset some of the downside, but you're still relatively exposed to the name on the downside.
Okay. So let me ask a question here. Or let me maybe make a point. I don't know. So in essence, though, if you're long this stock in the first place, you bought this stock for a reason. So you have an opinion that this stock is going to appreciate in value and go higher, right? And it sounds like what you're saying here is this isn't necessarily an explosive idea that it's going to go up zillions of points. Hence the reason why you might want to sell a little premium with the call to, enhance your income potential. So this is a longer term hold with the stock, it sounds like, and we're going to try to generate a little income over time by having this position, and quite frankly, a bit of a bullish kind of mindset. Is that safe to say?
Definitely. Like in terms of selecting stocks here and thinking about, what names might be interesting, you definitely want to select stocks that you are bullish on, right? That this isn't going to cover your downside. It's not a short play. That this is distinctly a long bullish play on whatever name that you're looking at here. So absolutely, can be done against existing holdings or, initiating a new position.
Okay. So what are some good stocks to pick? Is there kind of a rule of thumb that these types of stocks are better than those types of stocks? Any thoughts on that?
Yeah, great question. So I think, when we're talking about collecting premium by selling that call and capturing that extrinsic value on that call, you're going to collect more premium the higher volatility that name is. So often names that are going to be relatively higher vol tend to be a little bit more interesting because you're going to collect more premium and more kind of yield. Some way is one way to think about that too. So high vol means higher premium. It's also going to mean higher potential downside risk, of course.
Sure.
Higher vol names are also more likely to go down. So it's an interesting balance there from a volatility perspective. Single names tend to be better than indices. The indices tend to exhibit relatively low vol. So, when you're selling relatively cheap premium in the indices, if we see a big market rally, you're not really collecting enough to sort of offset your risk there. So, single names are good. Dividend paying stocks tend to be interesting. They tend to exhibit a little bit more smooth performance. But again, I think going all the way back to your original point, it's got to be a name that you're bullish on anyways.
Right. Okay. So safe to say, we're not looking for stocks that have gigantic volatility that go up and down, kind of like a GME. It's probably not a great candidate for this type of strategy, is my guess, right?
Yes and no. I think
it'd be good.
I remember looking at GME back in the heydays. I think it was back in February, and we were seeing out of the money calls that were 100% out of the money that were trading for half the price of the stock.
Yeah, that's crazy. So to your point there, then, because implied volatility is so stratospherically high, it just makes, it's probably a pretty decent play to get some of that high premium on the books, right? Selling some of that high premium. Yeah.
Exactly. And, to the extent that you can sell a call for an incredibly high value and offset your cost basis, maybe that is a reasonable place to do it.
Yep. Good point. Good point. Okay. So we tend to look at these stocks, bullish on these stocks. Now, what about, which strike are we picking, right? Are we in the money? Are we out of the money? Explain a little bit about that and some of the intrinsic, extrinsic value prop here and the premium levels. What are your thoughts there?
Yeah, so that's one of the really interesting kind of questions as you're looking at, where to, not only what names to pick, but where to set the strike. And so, often we think about selling something that's out of the money. The further out of the money that you go, the more potential upside you might get. If you sell something that's directly at the money, you're going to collect a higher premium, but you're going to have less room for that stock to run. So if you're very bullish, you might want to lean a little bit more of the balance towards selling something further out of the money, giving stock room to run in exchange for collecting less premium. If you want a little bit more certainty now, selling something potentially at the money, or even if you're bearish on the name, selling something slightly in the money, and giving yourself some room for that stock to go down a little bit can be an interesting play on that. So if you're feeling a little bit more defensive, I've definitely seen strategies where selling something like the 60 delta call that's, somewhat in the money, you're still capturing a decent amount of that extrinsic value on the near the money calls, but you're giving yourself a nice downside buffer by also collecting some intrinsic value on that should the stock go down a little bit more.
Okay, great. Those are good points. Now, you're calling this a covered call strategy, and I've heard the term bandied about, and I know it from my trading days, called buy rights. What's the difference for the viewers between a buy right and a covered call? What do you see it? And you're like me, an old trader. You're not old, you're young, but you're a trader like I was. We did buy rights, we did covered calls, I suppose, but we traded, right? So how does an investor / trader look at the difference here? What's the important takeaway?
Yeah, a lot of different words that kind of get thrown around here. Generally, I'd almost say at the high level, there's this concept of overlay strategy. So I think a covered call or a buy right both fit into this concept of overlays, right? That these are options positions that that overlay a stock position. But at least the way I distinguish between the covered call and the buy right is a covered call is a little bit more like a strategy in the sense that it's something that we're repeating over time. Again, that consistency element here. Whereas a buy right, I think that's what we called them on the floor because when it was actually a trade, you would buy the stock and write the call against it.
So as one
that
package.
would be done as a package.
Okay, got it. That's the difference. Okay, so the buy right we do together as a package, stock and options, send it to the complex order book, and someone trades it, we hope, and we have a position. Whereas this covered call, I get it now. You already have the stock position and you're selling these calls each month or each week, whatever your strategy is. Okay, that makes sense.
Yep.
So
you're covering your existing holdings with these calls.
Got it. Perfect. I love it. So these things, time goes on. Hopefully this works for us. What happens as we approach expiration? And what's the process there? I know there's got to be some rolling consideration or some expiration consideration? What are your points there?
Yeah, so as sort of time goes on, you're going to have some stock movement, you're going to have some options decay, your short options, meaning you're collecting theta, meaning as each day goes by, your position is going to gain a little bit of value due to those options losing their premium. Ideal scenario, stock's going to go right to your short strike. That's usually, especially with an out of the money call, that's going to be your best case scenario, is that stock goes right up to that short strike, your premium completely deflates, and you've made, income on, or not income, but you've made P&L on your long stock position.
Mm-hmm.
So that's not always the case. Best case scenario rarely is what exactly how things work out. So what you can do if the stock is either over the strike or significantly under the strike, you might want to roll that position. So a couple different ways you can roll. You can roll up. So you can buy in your short call and sell a further out of the money call. To roll that up, give the stock a little bit more room to run. You can roll it out. You can roll it across a different term. So, as we approach expiration, you might want to say, I'm short the Oct 15 call. I want to roll that to the November expiration, or I want to move that out a week. So you can roll up and out, of course, too. Sure. So a lot of different ways that if the stock has gone in your favor and starting to go through that short strike, rolling up or out is a great way to sort of adjust that position over time.
Okay, so great. And then if I want to keep my stock position and it's in the money and expiration's coming and it's going to expire, my short call is going to take away my long stock and I'm going to be left with nothing. But I don't want to have nothing, right? So I can buy that short call in before it expires and roll it out somewhere else. So now I still have my stock in tow and in my inventory, right?
Correct. That at expiration, if that call is in the money, the short call is the right to sell 100 shares of stock. So you will automatically exercise your right to sell those 100 shares of stock if it's in the money, and your 100 shares will go away. So to your point, if you do want to keep those, rolling is kind of the best way to make sure that you can kind of continue this game over time. And kind of keep with the strategy to continue generating that income.
Got it. And what happens if implied volatility of the options goes up, goes down? What should the newer investor trader understand about that with this position?
So there's definitely, I mentioned that this position is collecting theta. You are also short volatility by being short an option. So you've sold some volatility level when you initiate that position. So while ultimately at the end of the day, where stock finally lands and settles on expiration is going to be the determinant of whether that call makes or loses money. In the interim, you could see some marking scenarios where stock doesn't move and that call goes up in value. Or stock could even go down and that call could go up in value if we see a rise in implied volatility. So throughout the life cycle of that covered call, you could see the value of that call fluctuate based on other factors than simply where the stock is. So this is a short vol position that you might see some marking differences, over the life cycle.
Sure. And what about, are there any risks with dividends relative to, early exercise? Because you're short a call and you don't control the exercise. You're exposed to assignment, right?
If that call is in the money, you're absolutely exposed to assignment from someone that wants to punch or exercise that call so that they get the shares and collect the dividend. Okay. If you do remain long those shares, you of course are going to get that dividend. The value of the stock will go down by that dividend amount. You'll receive the cash there. So dividends, are something to pay attention to both on the exercisability question, but then that's also going to compute into the eventual value of that call. So if you're writing calls and there's expected to be a dividend, you're going to see that premium be a little bit lower than expected because the options pricing knows that a dividend will be paid during that time. So that options is pricing is based on the forward value of the stock, which includes the dividend to get paid. So it's something to pay attention to in terms of pricing if you are writing calls during a period when a dividend will be paid.
Got it. Okay, good. And then I think you touched on this earlier, but if the stock goes down, we're going to lose on this position. I mean, if it goes down a little bit, probably not too bad, but if it goes down a lot of bit, not so good. You're long the stock, you're short the call. We know what that is. That's a synthetic short put, right? So probably not great.
Exactly. This is, like we said at the beginning, this is a bullish position that you want to pick stocks that you think are going to go up, that still have, the long-term positive, momentum. But if stock does go down, that's not the end of the world here. Like you said, you might lose a little bit of money now, but one of the things to pay attention to going forward is that what is your cost basis on this stock? That if you're going to continue to be writing calls against a name that you still have, a good feeling about, you want to make sure that if that stock goes down, that you're not selling a call below the level at which you own that stock or which you bought that stock. So, by way of example, if you buy stock at $50, sell the $55 call, and stock goes down to $40, well, if you sell the $45 call the next period or the next month or week or whatever it might be, all of a sudden stock goes back up. You bought stock for 50, you sold it out at 45. You've got to make sure that you've collected enough premium to make that worth it, or you're setting strikes at a level where you're not going to get chopped up in terms of cost basis.
Right. Understood. Okay, good. Well, this was great, Mark. I think this is a very good income producing strategy. Again, there is risk, right? We just talked about that. I think it's probably easy enough for even a newer trader, options trader, to understand. Right, as we talked about the expiration risk and in the assignment risk here, and it's a consistent sort of thing that you can do month in and month out, or week in and week out for that matter, right? So I think this is a good look at a covered call strategy.
Yeah, it's a great strategy, relatively easy to understand, and there's so many different ways that you can deploy it. Across different names, across different strike levels. It really has a ton of flexibility and potential for really how aggressive or conservative you want to be with it.
Perfect. All right, great. Well, good. That was a good episode. Give us a like and don't forget to subscribe. We do this every Thursday on Options Brew TV. Mark's from Harvested Financial. And don't forget to subscribe. And Mark, you have a great rest of your week, and we will see you next Thursday.
That sounds great, Lex. Thanks again for having me.
All right, good deal.